All right. Well, thank you, Ramez. I appreciate the opportunity to be here. To be honest with you, you and I have talked for a very long time about this, and I think both of us are pretty excited about several things that are going on out there with IRA Club and kind of the reason that, we wanted to discuss being beside you guys, and the growth that you guys are bringing and things of that nature is just incredible. And you're a wonderful opportunity and resource for people in the IRA world, which can be a difficult world to navigate. There's no doubt about that. It even
Thank you.
helps guys like me, who's been in this business for 35 years. I can't keep up with every single little detail in the market. There's so much that comes at you. We can rely on guys like you, so I appreciate what you do. Let me get straight to the presentation, and I'll go ahead and warn everyone that I speak in a word burst of 200 miles per hour. It's just what I do. So I'm sorry if you're gonna get a whirlwind of speed here. Just the more comfortable I get, the faster I talk. Sorry about that. But let me go ahead and tell you the agenda that we have planned for you today in our presentation is we're going to talk a little bit about this is the fastest asset class growth in the market today. We're going to talk about a strategy that gives you true diversification. I'm going to talk about what true diversification really means. I'll define that for you and tell you some of the errors and the myths that you've heard about diversification. It's kind of an interesting thing because this is a line, to be honest with you, that was a slow becoming for me. That over years, managing assets, watching things, I'm looking in one hand what I'm reading and I'm being told, and I look in the other hand at what I'm experiencing every day in the portfolios, and they didn't add up. So I started questioning, and that's where this came from. And then we're going to talk about why Buffett continues to pour billions into it. Very quietly, Warren Buffett has put an incredible amount of his wealth in this strategy, up to and including owning companies that work in this particular area. Ramez went through my who I am, so I'm going to skip that for you. Let's get straight to the current market issue. I think we need to take a look at the current market, even though we're talking about something a little bit differently. I want to set the table for you a little bit of where you're at and what we're dealing with and why this asset class needs to be looked at. We all kind of know this. I'm not going to go into a detailed market analysis here. If you guys give us a call, I'm more than happy to unpack this in a much, much more detailed way. And if it's just something you want to use for your own portfolio outside of what we do, I'm happy to do that as well. But when we look at the equity market in 2002, and really even looking back in a trailing 12-month fashion, January of last year to January of this year, it's having a terrible year. It's having a historically bad year. And that is normal because the Fed unwound its QE programs, the infusion of money into the market in March of last year. And as soon as they stopped that, the market has kind of flipped upside down and started its revaluation issue. The timing of that wasn't very good because we're also teetering on the edge of a recession. I think we are already in a recession at this point, the very light points of it. We'll see that recession deepen, but you should expect over the next 90 to 180 days to hear deteriorating economic numbers. We're seeing a lot of people say they think the market is stabilizing. Well, the market will unstabilize, if I can say it that way, once you start seeing these deteriorative economic numbers come out. Bonds, really a historically bad year for bonds. If you look at the 5 to 10 year bond averages, you were down over 12%. If you go out to longer, 10 plus years, you were down in some cases more than 20% on bonds. Remember, this is the safe place to be. That's not going to stop most likely, and I'll discuss that in a second. We look at volatility. The volatility on the market in 2022 is the historically highest volatility we have ever seen on the market. Interestingly, the second highest volatility was 2021. Before that, it was 2019. What you're seeing is a systemic increase in volatility on the market. That volatility most likely is going to stay as well. I've already mentioned to you that I think we have a recession coming next, 90 to 120 days. You're going to hear that. I say I think we're already in it because recessions do not pop up overnight. You kind of drive slowly into them and then slowly back out of them. So you're in a recession much quicker than you're actually reported that you're in the recession. Remember, the word recession is kind of a mathematical term of 2 quarters of negative GDP growth. That's when people kind of throw the flag up and start using the R word. But once you start seeing, the GDP get down to less than 1% growth, at 0 growth, you already are seeing the recessionary pressures of the market, recessionary pressures of your economy happen at that point. And so that we have to kind of go through slow to stopping to reversing kind of that stream through there. So that's why I say we're most likely already in a recession at this point. Now, let's take a look at the future, if you will. It's very important. We all know what the past did, but it's really about where are we going to go and how we're going to handle that. Our firm predicted in spring of 2021 in a note that we published that the S&P 500 index would generate about a 5 to 7% return over the next 5 years. That first year of that 5-year period was 2022. So we indicted the equity market in 21 as being overvalued. We indicted as heading toward a cliff and looking specifically at the Fed unwinding its QE programs as the catalyst to tip that off. And we saw that that absolutely happened. Looking out from here, we've got 4 years left in our 5-year prediction. I do believe we're going to have a market year in the next 4 years that's going to be incredible. We're going to have a couple of years that are just kind of going sideways. But all in all, when we look at the assumptions of the market going forward, I stand today by that 5 to 7% call. As much as I did today, I made that call back in 2021, and we will most likely see, obviously no one has a crystal ball, but we will most likely see the S&P fall into this 5 to 7% annualized return. That's a problem. Part of that problem is it's not much more than the predicted inflation for that period as well. So if we hit a 5 to 6% return and a 5 or 6% inflation, you are treading water, which means your wealth is going up by the same amount that your costs are going up. So you're not really getting anywhere during that time frame. If we look at bonds, we at the same time predicted that bonds would return around a -3 to -5% over that 5-year period. Last year, again, was the first of that 5-year period, and we've seen the most dismal bond market we've seen in decades, and that's not going to stop for a very long time. In fact, our firm is on record as saying we believe we have entered a multi-decade bear market in bonds, and that over the next 20 to 25 years, you're going to see bonds trailing downward, not upward. They'll go sideways sometimes. Nothing goes straight where they're going to go, but the bond market has to stabilize its rates. And that's what you're seeing with inflation shooting up. The Fed has overreacted on rates. They've killed the bond market. We still have interest rate increases left in us. There's a chance you're going to see 1 or 2 more interest rate increases in the next 90 days. That's going to depress the bond market a little bit more. We think they'll pause for a little while. All of this is our speculation, by the way. We have no crystal ball, but we look at the next 4 years, the bonds coming in at around 2% positive return. So if you look at the 4-year 2 to 2.5% positive return plus this double-digit negative return, it's going to put us into this -3 to -5%. The problem with that, of course, is the same as I said with equities. Inflation is going to offset. That becomes your bogey. It's going to offset your gains by the amount of inflation. So if you look at an equity portfolio, you're probably going to keep up with inflation at best. If you look at a balanced portfolio between equities and bonds, you're going to lose to inflation. The heavier you are in bonds, the more you'll lose to inflation over the process. We have issues in the market. We are not positioned very well right now. Will it go away? Of course it will. I like Ramez said earlier, I love stocks. I like bonds. I don't love bonds, but I like bonds. And I think the market will stabilize and we will have good years and we will get back into a bull period. But just like you're in bull periods, you have to be in bear periods. And right now the market is kind of getting its sea legs about it again. We've had a very long run for a very long time. This is normal, by the way. This is a normal rotation. There's nothing uniquely bad going on. Well, I don't want to give you an overreaction to what we're doing. It's a normal thing for markets to rotate. After periods of up, it has to take a breather. It goes down. Everything kind of gets rebalanced and then it goes back up again. We're in that rebalancing period. It just takes a while. And it's been actually a very long time since we've seen a longer term reaction to the downside on the market. So this one's going to be a little different for us. It's going to last a little bit of time, and that can exacerbate people when they look at it. They get a little frustrated every time they open their statement. They look at it, it's a little bit less than before or about the same. So you kind of get frustrated over time saying, I'm taking on the risk of investing. I'm just not getting the return anymore. And there's really nowhere to go. So it's almost death by 1,000 cuts. And that's what we see going on this whole thing. Well, as I said at the beginning, when I founded this firm, I started with the how are we going to fix what we saw coming in the future which is here. How are we going to fix that? And our solution is very simple and very straightforward. And I'll start with a quote that I love when it comes to looking at portfolios and realigning portfolios. You've all heard it in different settings, but the quote goes, when's the best time to plant a tree? It was 20 years ago. When's the next best time? It's today. And that's the way realigning your portfolio is. The best time to realign your portfolio was about a year ago. January of last year would have been about the best time to realign your portfolio. If you didn't do that and you've gotten hit, what's the next best time? Right now is the next best time, because as we go forward, we still have the exact same issues and headwinds facing us today we did a year ago. The issue is not to cry over what happened last year. The issue is how do we fix going forward so that our wealth stays intact, our long-term plans stay on point, and we're able to make sure that we are looking at the risk of our portfolio and that we are getting rid of losses everywhere we can. Trust me when I tell you, managing your losses is a huge issue for your portfolio. Losses will hurt you a lot more than gains will help you. So we want to avoid losses at all costs. So that's the thing we do. The other thing is we want to diversify our portfolio. That's how we manage risk, is through diversification. And now what we have to attack is diversification between stocks and bonds is not the answer. That's what you're told all over the place. Wall Street parrots that constantly, that you go between, riskier stocks to less risky stocks, to begin to blend in bonds, and you add bonds as you get older. That is not true diversification. I'm going to show you that a little bit later, exactly why I say that. So we've devised the solution here with Life Settlements that gives you true diversification. So what is true diversification? Well, true diversification is when you have one thing offsetting another thing. And that is if stocks are going down, bonds are going up. Now, there's all kinds of math that goes with this. And I'm not going to turn this into a math class, but you want to see them kind of offset one another so that I'm kind of rebuffing a little bit of the downside and still getting the upside at the same time. You may not offset it dollar for dollar. It may not be my stocks went down 2%, my bonds went up 2%, and I've got 50-50. That's not what I'm saying. I'm just saying that you have a portfolio that has your money spread around so that you're not all in one place and you get hurt when that one place goes down. And so you're looking for things that kind of offset that a little bit. That's what you're looking to do. And as I've said, Wall Street, which you should hear is actually a marketing machine more than anything. Wall Street will tell you between stocks and bonds, different kinds of stocks, different kinds of bonds, mix things up, you're going to be fine. And then you wake up and you realize that in 21, the S&P was up 26%. And then in 22, it goes down 19.4. So I've almost wiped out my great 2021 year. Okay. I've almost wiped that out, which means I went 2 years and I had about a 6% return or about a 3% annualized return. I'm rounding up a little bit there, rounding up on that kind of scenario. But I gave up over that 2-year period. I lost to inflation. Well, look at the bonds to the right of the chart. The 5 to 10-year bonds was down 3% in 21. That looks like diversification, doesn't it? Stocks are up really high, bonds are down a little bit. But then you flip over to 22 and look what happens. Stocks plummet and bonds plummet more. You lost both sides of the transaction in 2022. This has happened a few times in the market, and it happens when you have a systemic problem in the market. You see people no longer run from stocks to bonds. That's normal. In a normal market rotation, normal markets, when things aren't great on the stock side, people jump over to the bond side. Then when things aren't great on the bond side, they'll jump over to the stock side. What happened last year is stock people ran to cash, bond people ran to cash. Interest rates shot up. There was nothing to support the bond market. And you see the entirety of your portfolio goes down. Why is that? Because it's not truly diversified. It's sort of diversified, but it's not completely diversified. Therefore, when we hit these periods like 2022, you take it on the chin from a portfolio point of view. And the only time we see this alignment that you're talking about here, this alignment of both sides of your stock and bond portfolios go down, happens to be the very time you need it the most. We don't need extreme diversification during normalized markets. We need it when we have systemic issues. So diversification has begun failing us every time we need it the most time. in the diversification definition that you've been told. That's why my challenge to the people when we founded this firm was, I need assets that are going to truly diversify a portfolio. Do I believe you should be out of stocks? No. Do I believe you should be out of bonds? No. I think you have to have stocks, you have to have bonds, but you have to have more than that in a truly diversified portfolio. You need to have other asset classes included. It needs to be all kinds of assets in your portfolio, not just stocks, not just bonds, and not just staying inside of stocks and bonds. So I'm not indicting stocks. I don't want you to hear that. And I'm not indicting bonds. Don't hear that either. All I'm saying is we have to be smart about how we put those into the portfolio to meet the goals that you're trying to meet, to look at the line of what you're trying to accomplish in terms of your needs financially, and make sure that your portfolio is aligned for you, not out of some pre-planned, portfolio allocation. So with that being said, let me introduce the solution to you as of where we're going on this. And that is, again, true diversification. This solution will do things such as, it is not affected by interest rate moves. Interest rates going up, staying the same, or going down will not affect the value or return of this investment. It is not invested by politics. It does not matter who's in the White House or who controls Congress today. It doesn't matter who's going to control it in the future. It is agnostic to the actual political realm, if you will. It's not affected by the economy. We're going into a recession. We talked about that. Is this going to deteriorate because of recession? No. It doesn't matter if the economy is the best economy we've had or the worst economy we've had. It's going to do the same thing. And it carries zero volatility. Absolute zero volatility. So as the market, stocks or bonds go up and down, this stays exactly the same. What I'm talking about are life settlement investments. And so let me go ahead and define for you what we mean by life settlement investments. This is when we purchase. Moss Point is when I say we, I'm talking about Moss Point for its clients purchases a pre-settled life insurance policy. Okay. This is when people who no longer need or want the policy they have, and for whatever reason, there's hundreds of reasons why they no longer need these policies, will take the policy back to someone and say, buy this policy from me. This is a little bit like even, selling your car or selling a home, a vacation home. I don't need my vacation home anymore. I put it on the market, I sell it, and I get the cash for it. So the individuals with the life insurance, they go, they sell it to another person and say, pay me some value for that life insurance policy. And so what we do is we go to the people who buy them. And I'm going to explain this a little more detail later. We go to the people who buy them and we comb through them and look and see which ones we think are interesting to buy on behalf of our clients. So let's get a little bit more into this process so you can kind of understand exactly what I'm talking about on here. So life settlements, and this is generic, by the way. What I'm telling you is generic. This isn't all Moss Point. When I talk about the settlement process, that's any individual that has a life insurance policy that wants to sell it to any other financial firm out there. It all works kind of the same. And that is the original owner of a life insurance policy. Let's say they've got a regular life insurance policy. They've had it for 10, 15, 20 years, whatever the case is. They don't want the policy anymore. There's a lot of reasons, like I said, that they don't want them. Sometimes people fund their retirement with selling their life insurance policy. Sometimes they fund giving monies to, their estate planning, give monies to their kids and grandkids with the proceeds of it. Sometimes they just have too much and they want to downsize their life insurance policy. There's a lot of reasons why they want to sell it. You can go to firms called providers. So the name of the role will be a provider, and that provider, and a great example of this will be a firm like, say, Abacus. Abacus is a provider, it's our preferred provider, quite frankly, that will sit down, look at your policy, they'll read it, they'll determine what you've got in front of you, they'll check your health records, they check all of the legal issues around it, they go through a due diligence process, determine what they're going to pay for this policy. And they offer you a lump sum up front to buy the policy. When they do that, this institution takes the role of the insured. So the institution, the provider, now is paying the premiums, and the provider gets the proceeds when that policy matures. So they're like a wholesaler in a certain sense. So they go to the individuals in their homes, they buy the policy, and then they warehouse it. They hold that policy. Then the provider, of course, has the role of wanting to sell the policy to someone else. That's how the provider makes their money and gets their money back to do it again. If not, they'd end up running out of money, holding policies and just sitting there. So what the provider does is they inventory or warehouse these policies, if you will. They administer the policy, which means they continue to check the medical records of the insured. They continue to pay the proceeds or the premiums of the policy to make sure everything stays in force. And then comes a firm like MossPoint. What we do is we look at their inventory. And there's some policies we want, and there's some policies we don't. We have a set of criteria for our clients that we believe gives us the best opportunity to hit the targeted returns we're seeking for our clients. And that's going to be age of the policy, how long to life expectancy. Is it going to be a 1-year life expectancy, 10-year, 20-year, whatever we're looking at. And I'll get a little more specific on phone calls with you about exactly what those are. We sit down, we conduct a review of these. We do our own due diligence of the policy, and we select the ones and bid on buying those policies out. And then, so what the client and MossPoint gets together at this point, and the client would open an account with us. They would transfer monies to us. We hold our monies in Citizens Bank, but understand this all goes through with you guys, the IRA Club. One of the real advantages for IRA Club, and this is something that drew me to them, is IRA Club has the ability to hold this in-house. We don't have to get other people involved. And so the monies they don't have to leave the IRA Club directly. Makes it very easy for you to be able to use the account you already have and bring us into the fold, bring us into your asset mix, and stay within the IRA Club. There's just really, to be honest with you, of all the self-directed IRA providers out there, is what makes IRA Club our favorite one, because they actually custody it. We can talk directly to them. They know what they're doing. They stay on point. They're industry experts in what they do with everything. And they really have a partnership with us on behalf of the clients. It helps us a lot. It helps them a lot to do this. So this presentation, by the way, is a little bit more generic on there. Probably should have changed that, but I do want you to know that in your case for this webinar, you stay with the IRA Club, and we like that, and we want that to happen. So, and then what happens when we get IRA Club involved, we open up what's called a Series LLC to hold those monies. I'm going to pause on what that is until later. It's extremely important. It is one of the more important factors we will talk about when it comes to life settlement investing. But because it needs to be a conversation to its own, let's kind of stay on point here and say that, what we then do is we get those monies. We're sitting down with, this is the amount of money we have before us. We look at constructing the portfolio from life settlement portfolios. Then we begin to manage that portfolio portion on behalf of the clients. We don't manage your whole portfolio. We're not managing your stocks, bonds, real estate, commodities, or any of these other things. We're only managing the life settlement portion of your overall portfolio. Now, we'll comment on it. We'll give you our thoughts on it just generically. But when I say manage the portfolio, I'm speaking specifically to the life settlement portfolio. We do that through the Series LLC, and this allows for participation by IRAs. So what we want you to know is that this is an eligible, SEC recognized participation for IRAs. So you're good to go in terms of this being an eligible investment. And then we provide you a quarterly statement. So every quarter you'll get a statement just like you do with your normal investment account saying, this is where my money is how much is in there and what my market value is. Now, let's talk specifically about Series LLCs and commingled funds. So when you own a life settlement, think about this. If I buy $1 million policy, it's worth $1 million in face value. And we bring it in at about, say, $600,000 or $700,000. You're going to make the difference. Okay, you're going to make the difference between the $600,000, $700,000 up to $1 million. You're going to pay some premiums along that line. You're going to pay fees to us along those lines. And what we do is we target about a 12% return. We'll talk about that a little bit later. But it is actually held, the physical policy is actually registered in the name of the Series LLC. Why do we do that? We do that because it puts you in direct ownership of the policy, not this firm, not Moss Point, and not IRA Club, and not anybody else. You have direct control and direct ownership of the actual financial instrument itself, which means if something were to happen to me, something were to happen to this firm, it does not matter. That asset class stays intact. It stays completely in your control the entire time. It allows us to customize the portfolio. It allows us to do different things as we need when we talk to people about what they're looking for. It is held independently outside of this firm this way. That way, you know, everything's not in-house. We want to make sure there's oversight and there's appropriate accountability being brought to us and to everybody in the chain of this transaction. So the Series LLC lets us do that. It brings full transparency to regulators. They're able to see every single transaction. They know where it is, what's going on, how the money moved through it. And then, of course, it gives us the ability to appropriately diversify within the portfolio. We're just like anybody else. If you go to an equity manager who's going to buy stocks for you, they're not going to buy one, they're going to buy multiple stocks so that you have the ability to spread your risk across them. We do the same thing. We get multiple policies in there, some of them a little longer, some a little shorter, some are larger, smaller. We craft very specifically that portfolio using math, using all kinds of analysis to sit down and say, this gives us the best probability and possibility of going where we need to go. We have lots of metrics. Again, I can discuss those in a phone call with you at depth if you want, but that's what we're looking for. Commingled funds, that would be an alternative. And that's where a lot of other people manage them as a one big portfolio. The problem with a commingled fund, when I looked at those and I decided, you know, how are we going to structure these? There's no direct ownership of the asset to the client. The client is a secondary owner. The client doesn't own the assets. They own shares in the fund. The fund actually owns the asset. So if something happens, all you can collect on is the shares of the fund. Well, if it happens at the fund level, you've got a problem. Cannot be customized. It has limited transparency. They're not required to show you what's inside of the fund at that point. There's liquidity risk because people are coming and going. So they have to make sure there's cash to be able to do the things they want to do. There's a premium funding risk that is associated with them. There's a manager business risk. There's a gating risk. There's all kinds of risks that come with commingling into one big fund on life settlements. So what we do is we decided to avoid these risks by creating the Series LLCs. Frankly, it puts more work on us. It is more work for us, paper-wise, administrative-wise, to do the Series LLCs, but it is a superior way to do it. It's superior for our firm. It is superior for the clients. It's superior for the IRA custodian like IRA Club. It works better for everybody. So it's worth the time and effort that we put into it. Now, let's look just quickly at an overview of this. This is a very low risk solution. Why is it low risk? Because if you think about it, your risk is not, is it worth the money in the future? There's no speculation here. There's no speculation. You know, when you get the policy, if you've got $1 million policy, you're going to get $1 million at maturity. That's what you're going to get. When you go into it, you know exactly what you're going to pay before you invest your money. Because we bid, we're told we won the bid. So we know exactly how much I'm going to pay to own the policy. I know exactly how much it's going to cost me to maintain the policy. I know exactly what the fee is going to be, which is a one-time fee up front. We know exactly what the dollar amount of the fee is going to be. So this simply becomes a big math problem. How much are we willing to bid? And our target is 12%. That 12% is net of all cost. That's 12% to you, which means we look at the face value of the policy, we subtract out how much the premiums are going to be, how much the fees are going to be, and then what 12% per year would be for the life of that policy. And that's what our bid number is. And so when we buy a policy, we've already got built in a 12% return. Now, is that going to happen? Like any other investment, you cannot guarantee you're going to get 12%. That's not what I'm saying. What I'm saying is when we buy it, from the day I buy it, if it matures exactly on the day of the life expectancy, you're going to get 12%. Now, what happens if it matures early? Well, you make more than 12%. Because now you've gotten the same, remember, you're going to get in my example, you're going to get the $1 million. If it matures the first day or a year afterwards, you still get $1 million. It's not adjusted for the time that you hold it. You get back the pre-stated amount, just like your life insurance policy you own. Whatever the contract amount is what you're going to receive. The time factor does not matter. So what we attempt to do is look for policies that are skewed to mature early. Over the life of our firm, we've been able to do that around 75 to 76% of the time. So about 3/4 of the policies we buy mature earlier than we actually have modeled them on, which means our returns are higher than the 12%. That's why it's a low risk issue, is that we do not have to guess about what we're going to get. We do not have to guess about what we're going to go into it with. The only unknown here is the life expectancy, and that we do not know. But we use actuarial firms, just like they do with any policy when it's established, to do reports based on medical records and all of the factors to determine what that life expectancy looks like. And you would be surprised at how incredibly accurate these life expectancies really are. So chances of going much longer are much lower than going earlier. So when we look at an quote unquote error factor, they're error toward the short side. What do I mean by that? The chances of you seeing one mature early is much greater than one going long. And we have data that we can talk to you about on what that really looks like on everything. So by avoiding the speculation, avoiding the punitive fees of annuities to help you lock in returns, the illiquidity nature of real estate, which we like real estate, or the interest rate risk of bonds, which we think is extremely high at this point, we believe life settlements today, 2023, is the preferred asset class for individuals in a retirement setting at this point, whether it be an IRA. Quite frankly, we love them in pensions. We love them in 401ks as well, where you have, and Ramez just went through this, you have a limited ability to get monies in. So you better be very concerned about losing those monies, because you can't just run out and replace them very easily. There are restrictions. So we look at trying to mitigate these losses, and that's where life settlements come in. It's just look, it's not exciting. I'll tell you straight up, this is not an exciting investment. You're not going to jump up Monday morning and look at the news and run over and want to see what your life settlement portfolio has done, because it's a very simple, it's a very plain vanilla kind of investment. It just kind of sits there and clicks along day after day. But in terms of doing what you need it to do, which is you're not going to wake up and see the life settlement world flip upside down and go down 2, 3, 5% in a day. You're not going to see someone walk up to a microphone, a president or someone from another country, whoever it may be, or the Federal Reserve, just as examples, and say something that is adverse to your portfolio. That's not going to happen. There's no situation that makes these investments deteriorate based on information, because it is a contract. It's a preset contract. So that's what you're investing in at this point. With that being said, look, I know I haven't given you enough information to make a decision. We built this presentation knowing that was the case. What I want to do today, my goal today, was to simply let you hear this, hear the possibility of a life settlement, the possibility of whether this might be something that you would like to see in your portfolio. And really, this is an introduction for an introduction. And what I mean by that is, if you hear this, you think, wow, this is something that I might be interested in, but I don't know. I would just encourage you to jump on the phone with us and let's talk specifically about where you are, what you're trying to accomplish. Let me fill in the holes of anything that I've skipped over here. I'm sure I may have misstated something if I go back and hear this, or I didn't belabor a point that I should have, anything of that nature. So it gives you a chance to kind of question me specifically about your situation and how life settlements would, interact with you specifically and what you could expect. And we can give you more data on what our long-term management has looked like and numbers and things of that nature. So I would ask you, if you're interested in this, that you go through what Ramez said about the link and set up a call with us, and let's sit down and just talk about your portfolio. If you want to just talk about stocks and bonds and the economy and things that we're talking about and seeing out there, I'm happy to do that as well. That's part of our offering. for RA Club, because we are so supportive of what they do. We want to help them add value to the clients, and that's you. So we want to be able to sit down and do anything we can to make your portfolio better. When it's all said and done, investing, I don't care who it is, it's our firm or other firms. We're here to help the clients, because when clients win, everybody wins. And that's what we're trying to do.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.